Well, the point is if an economy is not growing, it's not going to be job creating. You've heard it since the start of the bulletin. South Africa is once again in a recession. The overall economic growth for 2019, you've heard that number, 0.2%. Statistics South Africa releasing those figures a while ago, and it showed between October and December the economy contracted by more than 1.4%. Here's a picture of what happened in 2019. You have that contraction at minus 3.1% at the start of the year, and then a blurb up, possibly through base effects and some performance in good performance in the mining sector. But then again, the story got back to reality between July and September, the economy contracting by 0.8%, and then in the last quarter, as I said, 1.4% of a contraction. Generally, economists thought that between October and December, this economy would contract by 0.2%, so much worse than we had expected. Here's a look at what happened inside the economy. Your primary sector contracting by 0.4% in that period between October and December last year. Look at agriculture, not getting back on its feet as we hoped. That took a 7.6% slide. Mining, we know, because of commodity prices, did go up perhaps a bit, 1.8%. And then your secondary sectors, we kind of look at sectors like manufacturing. They contribute anything between 12 to 13% to GDP. So we're very interested in the job creation around here. But between October and December, a contraction of 1.8%. We know the economy is not doing well with infrastructure projects, so it's a given that the construction would go down by almost 6%. And then when we look at the tertiary sector, not even the financial sector, which usually comes to the rescue, it's up by 2.7%, but that wasn't big enough to actually get this economy back on its feet in the fourth quarter. Trade's an interesting one. It was down by 3.8%. I would imagine in the run-up to the festive season in December, you would see some of the retail stores churning out a little bit more activity, but not the case. Well, let's get more details now into why we are in this situation. Dr. Thabi Leoka, independent economist, joins us now. Thabi, thanks for coming in.
It's a pleasure.
I would have thought that we had underestimated the effects of what Eskom can do. Most economists thought the negative figure would be around 0.2 to 0.3%, but we contracted to such a large extent, 1.4%. What did we miss?
I think that there are two elements here. I think the retail sector, if you looked at the trade component, it is a lot weaker than expected. And this is the retail or the trade component of GDP includes retail, wholesale and vehicle trade. That declined substantially. If you go back to the employment numbers in that sector, you remember that employment numbers for the first time since 2008, and that's the financial crisis, the fourth quarter employment numbers actually were weaker. Typically what happens is hiring in the fourth quarter increases because of the festive season, and that speaks to the retail and the trade sector, that we actually didn't see a lot of trade happening in the fourth quarter. And then coupled with that, we had obviously the load shedding that we didn't see in the previous quarters. Load shedding really started in the fourth quarter, and that actually stopped production in manufacturing, and also some miners stopped earlier than usual because of the load shedding.
All right. Now, what worries me is that we haven't even gotten to the impact of the coronavirus. We have the second largest economy sitting up there in the north, China, which usually is the buyer of all our raw materials. That's now been taken a hit because of the coronavirus. What can we expect going forward because of this?
It is very worrying, because if you look at even at the expenditure side and you look at our imports and exports, so we're not importing because we're not consuming, but export growth grew. And my worry is that this export growth will slow as a result of a decline in demand from countries such as China, but not just China, but I think globally. The World Bank and IMF have both said that global growth will slow this year. This will have a negative impact on the South African economy. And let's not forget that recently we saw the equity market and the rand weaken as a result of the coronavirus, and this is likely to occur this year until such time that we have found solutions to and answers to this coronavirus. And we've seen at least those who are affected, or growth in those who are affected, decline.
We talk about low-hanging fruit every time we have a conversation, and one just seems that there's fewer fruit to pick here. All right, so if we're going to go solution-wise, we've got to fix up Eskom to get electricity back into factories. But then there's also this issue of policy uncertainty that many of the investors feel we cannot go through if we want to go ahead and throw our money into the South African economy. All of that while we have 10 million South Africans waiting for this economy to get active, to get employed. Where do we start fixing this?
So I think even before Eskom, because I think Eskom is a medium to long-term problem, I think one thing that will change the economy overnight is spectrum.
Yeah.
Release the spectrum so that you can, you'll start seeing the economy grow in various ways. Data will be cheaper, so there'll be more cents and rands in consumers' pockets. Conducting business will be cheaper. Looking for jobs will be cheaper. There's just so much that the release of data can do that is instant. And I think that needs to be hurried up. We need to see the release of spectrum. But obviously, Eskom is a huge problem, and it's going to be a problem throughout the year and possibly for the next couple of years. And this is what the CEO also alluded to, that the solution to Eskom is not going to be an overnight solution. And so we need to just be aware of that load shedding is going to be with us for a couple of years. So that also speaks to the rate of growth for the next 2-3 years that is going to be slow. And again, if you look at forecasts, either from the World Bank, IMF, Reserve Bank, and even National Treasury, our growth rate is not going to go much above 2% in the next 3 to 4 years.
We'll know how Moody's digests this later this month. Dr. Thabo Leoka, independent economist, thanks very much indeed for coming in. So what